Welcome to our weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. Also, if you want to come and see what we do in live markets, we hold our live market analysis every other Thursday, and it'll be this week. So just click on the link below if you want to come and see us Thursday morning. Where we analyze and point out trade setups and signals in live markets. Okay, first market we're going to cover, a little bit different order today. We're focusing on the most important chart out there right now. This is the 10-year note yield. It's U.S. Treasuries, the 10-year yield. Extremely important chart right now. You can see the market's just sitting below resistance. Treasury yields jumped 0.2% last week. That's a positive development for the U.S. economy and points towards the likelihood that the Federal Reserve will start to raise short-term rates as early as June. We think the most important theme out there right now will be higher U.S. interest rates. If the 10-year yield gets above resistance, right around 20.11, we think that opens the door to higher yields here. And why is this so important? Let me pop out to a weekly chart. And there you see I marked that box where you had a big jump in interest rates in 2013. Well, if you go back and look at the market, a couple things will stand out for you. Number one, the gold market collapsed at that point. So did the Australian dollar as well. So that was pretty significant. And we think you're in for another bout of higher rates. We think the interest rates are going to jump in here. A lot of reasons for that. Mainly that U.S. consumers are in really good shape. U.S. home prices are up nicely, and if retail sales are off a little bit, or the manufacturing numbers are off a little bit, that's not necessarily a bad thing for the U.S. economy. It just says that the U.S. consumers are a little bit more responsible now. The bottom line is that personal savings are up, home prices are up. So overall, we think the Fed's going to go ahead and raise those interest rates over the short term. That's going to show up in higher interest rates here. That's not going to be beneficial for commodity markets. So first chart we're starting out with here, 10-year treasuries. We think you're going to see higher yields going forward, and we'll see how that plays out in the other markets. Here's the Australian dollar. Let me go back down to a daily chart. No surprise, you had a nice big short covering rally last week, stalled out right at resistance, right at our RTT level, right at 2/3 of that down move there. So yeah, it was nice to have the move. It was fun to participate in it as a short-term trader. Do you have legs on this guy? We're going to see, but I have to come back to that Treasury yield chart also. If U.S. Treasury yields start to rise, just as that chart is telling us they potentially can, then that's going to pull the rug out from underneath the Aussie once again. The thing to remember about this rally that we saw over the last month or so is it is a secondary rally. It is a counter trend rally. The overall pattern here is still bearish. Okay, yeah, this may end up being a secondary bottom here or so, but in the long run, we don't think this guy has played out, only because we feel all along that higher rates in the U.S. Treasuries will propel the U.S. dollar higher again. Next market, take a look at, will be the dollar Swiss. Dollar Swiss had a pretty good sell-off there. Again, no surprise, we talked about that. I think it was 2 weeks ago. We said, what happens when that ledge gives out? Well, you're going to see lower price, and that is exactly what happened. You can see you have support just below the 50% support, right around the 92.5 level. So that would be a level to watch overall. Here's another one where things can change in a hurry. If those U.S. Treasuries break out on the upside, that would be a clear indication for us that Madam Yellen, that Chairman Yellen of the Fed, is going to stick to her word and raise interest rates in the second half of this year, as early as June, in fact. If you look at this chart on a little bit longer term basis, let's scroll all the way out to a monthly chart, you see a market that's essentially in a sideways pattern, right? So we think that sideways pattern will hold up. Outside chance you see 90 even in the Swissy. The bigger picture, however, we're pretty confident you'll see higher prices overall. Next market, the dollar index itself. Scroll down to a daily chart. we see pretty good support just above the 94 even level there. It went down and it tested that spike low that we saw back in March. And you actually had an update yesterday in the dollar index in sympathy with higher rates in U.S. Treasuries. Overall, we think that higher rates will be dollar bullish. That's kind of textbook economics there. So we still like the dollar index long term, holding on to those longer term positions. And at some point, we'll start to warm up to getting long again here. Obviously, we have to see how the 94 level holds up here, but keep in mind this is a secondary correction overall. By no means we see it as a sea change move, and if anything, it's just going to prove an opportunity, perhaps sooner than we think, if Madam Yellen raises rates, to get long the dollar once again. Next market, the euro US dollar. The euro a little bit stronger than the Aussie, and if there's one thing I know for certain about secondary moves, about a short covering rally, in this case, is that the market that has the most amount of shorts in it will give the most sustained short covering rally. It's just numbers. Everyone's short the euro long term, so it's the most susceptible to someone lighting a fire under those nervous shorts' feet. And what do? They cover, and that's why you had a pretty big update in the euro, and we talked about that possibility. Well, we've been covering that possibility for a month or so, and so it's no surprise to us that you did see it. I think there's an outside chance that you clear resistance right in here on that purple line overall, but we would see this market having a tough slog up to 115 even, and if it did see 115 even, I think that'd be the level that we'd have to step out and look to reset shorts in this market. So maybe a little bit more upside here. Overall, though, keep in mind, again, this is a secondary move, and it's going to be those U.S. Treasuries that are going to pick the tune that these markets are all going to dance to going forward in the second half of this year. Last market we're going to cover is the gold market. We think gold's very susceptible to the short side. No surprise, we've been pointing out that we've been in a bear market all year here. If you pop out to a little bit longer term chart, and I highlighted on that treasury chart, I highlighted what happened in the second quarter of 2013. If you go back to what happened in the gold market, second quarter of 2013, it was right here. The gold market collapsed. So it wouldn't surprise us if you do get the higher rates that the treasury market's forecasting right now. Gold will break down below current support, and that we'll see a test of 1100, and more likely beyond that, and there's a lot of room below in the gold market. Thank you so much. My name is Jay Norris. We'll be holding our live market analysis this Thursday. Click on the link below and you can come and see us teach in live markets, where we highlight current trade setups and signals. And I'll see you then.